Rainer Michael Preiss of Taurus Wealth Advisors. He's joining us right now on the show. A quick shift towards what the global markets are doing as well. Remember, Friday's session ended lower for most of the US equities on the back of weaker jobs data that came out. Rainer, just weigh in on this. We've been looking at the economic data points coming across the globe, and this time's jobs number that came in was much weaker than what the street had pegged in. Do you feel that much more focus now is starting to get laid on the kind of macroeconomic data points that have been coming out there, which have started to look slightly weak?
Yeah, look, I mean, this really is really the important and the big question. If you think about it, a lot of the equity market gains in the United States and as an extension of that globally last year were on the back of multiple expansions. So again, the underlying economy has been weakening. A lot of economic data has been sort of disappointing and weakening, and hence the real question is, how expensive can equities become? In the US, the equity market is currently around 18 times PE. 19 times seems to be sort of fundamental resistance in US equities. And again, fundamental resistance from which perspective? If you think about it, the US stock market capitalization to GDP is now at 150%, so it's the highest in history. How high can equities go? Who knows? But again, this is the level where actually we're getting at the level where at 150% of US GDP, the stock market increasingly is at level where it's at least as expensive. But again, what is expensive can become more expensive. So I think this is why the consensus view still tries to sort of think we could have 6 to 8% upside in US equities. But again, this is at risk of short-term to medium-term pullbacks, because short-term the market looks potentially overbought.
Okay. This week is also important, Rainer, from the trade deal standpoint. The signing of the first agreement on the trade truce. What's your take on how big this could be?
Yeah, look, I mean, in markets you often have this old proverb or adage. I mean, buy the rumor, sell the news. And if you remember, a lot of Bloomberg comment was always, so markets are rising on hopes for US-China trade deal agreement. Right now we seem to have something in writing, looks like it this week. So I potentially could see sort of a sell the rumor, buy the rumor, sell the news environment where we can actually see a pullback on the back of this. Because again, even though there's an agreement, does it fundamentally change that, what do you call it, what's the right word here? That struggle between the United States and China? Most probably not, especially since, in my view, the Taiwan election is now further complicating the US-China relationship, because like Hong Kong, Taiwan potentially could upset some people in Beijing.
The other point also to keep an eye out on is the fact that you'll be getting US inflation numbers, retail sales numbers from the holiday season. Now that we've already got a look into the jobs data, that's also going to be an important monitorable. Map that in terms of the kind of equity mood that you see coming out from the kind of numbers that they post.
Correct, and this is what we and a lot of investors are looking at, is exactly that question with regards to equities in the US. Will it continue to be driven by growth equities, growth stocks, or will potentially we see a shift into value stocks, right? And again, value stocks might actually benefit from the Fed agreeing, and Fed publicly said that they're willing to allow inflation expectations to rise, whether inflation expectations or inflation would rise to a level where it would potentially benefit value stocks. And this is also what the consensus view for many banks increasingly is, that the US might this year actually underperform Europe and other markets that are considered to be more value markets, like Europe, for instance, where European financials, European banks have very much underperformed, but European banks as a sector has a very attractive dividend yield in the global context. So the real question, I think we are seeing this, value could potentially outperform growth in 2020.
Hi, Rainer. Good afternoon to you from India. The rally that we've seen for equities globally has been liquidity driven. You said valuations for US markets are also at the tipping point. 18 times is a resistance that we've seen in the past. And if I were to map that with Indian equities, we are at life highs, and our valuations are also around the level where we've seen resistance coming in the past. Any thoughts, any views in Indian markets? Do you see the rally that we've seen, for the polarized rally that we've seen in the last 1 year, will that continue, or money could shift to the other emerging markets, maybe China?
Yeah, look, I mean, China increasingly looks to be a little bit more constructive, and also technically China looks more interesting. But I think with India as an emerging market, I think many global investors like the domestic consumption story. On the other hand, like Yes Bank, again today, some of these challenges with regards to individual sectors and bank stocks is still a concern. But I think more importantly, if you look at the global stock markets this year, what has done well year to date are mostly the oil-driven markets. So Nigeria is the best performing market in the world according to Bloomberg data. Russia is doing well. So all these that are somehow benefiting from higher oil prices. India historically has sort of had headwinds if oil would go higher. So India is one country that is a big oil importer, so higher crude prices is not necessarily constructive for Indian equities or Indian economy. So that I think is still continues to be a headwind, whereby foreign investors in emerging markets might actually see that the high oil prices because of the Iran tensions and so forth are headwinds for India. So I expect this to continue for the foreseeable future until we have some more clarity with regards to the US-Iran issue.
Point well taken. Definitely higher crude prices do not augur for Indian markets. We import nearly 80% of our crude requirement. Having said that, the crude prices have cooled off. But last year was a rare year where we saw, equities performing well. Even gold was up about 18 to 19%. Do you see that happening this year in terms of asset allocation, since there are some geopolitical tremors that we've just felt in the last 7 to 10 days, that money could continue moving towards yellow metal as well?
Yeah, look, increasingly I think the consensus is, as I said, the Federal Reserve Bank system, rather in the US, is increasingly willing to hopefully tolerate higher inflation. And that, I think, is the driver. The Fed potentially could lower rates again 2 times this year. That's increasing the consensus. So another 50 basis points reduction in US base rates. That is all very positive for the price of gold. And more importantly, in Europe as well, there's now increasingly political will to have fiscal stimulus. And that again, Europe already at negative rates, potentially going even more negative. This is all very positive for gold. And don't forget, gold is the only major asset that is still actually on 7, 8 year, 9 year lows, because almost everything in the world has gone up, right? I mean, some people call it the everything bubble, and gold has actually been lagging in this everything bubble, but gold is also the systemic hedge against any of these bubbles actually turning into a potential bear market. So I think gold is, in my view, the highest conviction call for this year, gold and gold mining stocks. And they also, if you look at the industry ownership, they actually technically still under-own. Many investors have still a very small allocation to gold and gold mining shares. The focus is still on technology and so forth.
Rainer, just one quick question, although you in part answered it. If indeed we see a comprehensive tariff deal and not a trade deal, do you believe the markets have room to move higher from where they are right now?
Yeah, it looks like it. I mean, the momentum is don't fight the Fed, don't fight the momentum. And the momentum for US equities is up. But I think at one point we have to have a reality check. And I think the reality check is coming in the next few weeks. And that's the US earnings season. I think we would seriously need to have earnings growth, not just multiple expansion. So that's why, again, at these levels, can you buy US equities? They can go higher, yes. But I think the risk level associated with buying at today's level, in my view, are rather elevated.